Okay, let's dive into this. We are talking about one of the hottest day trading strategies out there, the 0 DTE Iron Condor. But what if I told you there's a hidden flaw baked right into this trade? A flaw that secretly bleeds your P&L, and that most people are trading it completely backwards.
Right? You put on this trade thinking, hey, I'm market neutral. I'm just making a simple bet that the market will stay calm. But is it possible that the trade itself has a hidden bias, a secret bet that's actually working against you, especially right when the market opens?
So here's what we're going to do. First, we'll bust the common myth about the Iron Condor. Then, we're going to pop the hood and look at the hidden skew engine that really powers this thing. We'll see why it's so risky in the morning and how that completely flips around in the afternoon. And crucially, we'll cover why your backtests are probably completely missing the boat on all of this.
All right, let's kick things off with what we think we know. The Iron Condor myth, the idea that this is just an easy bet on a boring day in the market.
So just to make sure we're all on the same page, a 0 DTE Iron Condor is where you sell a put and you sell a call, creating a price range you think the market will stay inside. The whole idea is to just sit back, let the clock tick, and let time decay, that sweet, sweet data, do all the work so you can keep the premium. It's supposed to be market neutral.
And that's the appeal, isn't it? It feels so simple. You're basically getting paid to bet on the most likely outcome, that the market is probably not going to go crazy today. But the real question is that the only bet you're making?
And that, my friends, brings us to the real meat of this discussion, the hidden skew engine. This is where we pull back the curtain on the secret bet you're making without even knowing it.
You know, traders are obsessed with keeping their delta neutral, making sure they don't have a directional bet. But here's the kicker, the real enemy, the thing that's causing that mysterious P&L bleed. It isn't delta at all. It's the volatility skew. It's the very shape of the volatility curve.
See, the problem is that your Iron Condor is not symmetrical. Think of it like a lopsided seesaw. Your put wing, that sits on the fat part of the volatility smile. That's where implied volatility is really expensive. That's your hidden risk. Meanwhile, your call wing is way over on the thin side, where implied vol is cheap. So you've got an unbalanced trade from the get-go. So what does that actually mean for your wallet? It means you are short volatility where it's expensive and long volatility where it's cheap. This creates this totally lopsided P&L that has nothing to do with whether the market goes up or down. You're not just betting on a price range, you're making a structural bet on the shape of volatility itself.
Okay, so we've got this hidden, lopsided bet. Now let's see why it makes the morning the absolute worst time to hold this position. This is where that hidden risk really comes out to bite you.
This quote from the source material just hits the nail on the head. You are basically exposed to losses in the exact spot where volatility is the richest and most jumpy, and you've got your potential gains on the side where vol is cheap and doesn't move much. It's a structurally bad deal, and it's at its worst right at the market open.
And the numbers, well, the numbers don't lie. Look at this table. This shows us the skew vega, basically your sensitivity to changes in the volatility skew, right at the open. As you can see, the short exposure on your put wing and the long exposure on your call wing, they do not cancel each other out, not even close. You're left with a big, fat, net short skew position.
And that brings us to this one crucial number, negative 0.156. This is your hidden risk quantified. It's not neutral. It's not zero. It is a very real negative exposure that's baked into your trade the second you put it on in the morning.
So, what does this actually mean for your P&L? It's simple, and it's not good. It means you are set up to lose money whenever the volatility skew gets steeper. And guess what the number one thing is that makes skew steepen? That's right, the market dropping. So on a down move, you're not just getting hit by delta, you're getting hit a second time by this hidden structural flaw.
But here's where the story takes a fascinating twist. This risk isn't permanent. As the day goes on, the whole game changes. The afternoon is a completely different world. The hero of the afternoon is a little parameter called beta 1. All it does is measure how steep the skew is. Just look at this timeline. At 9:30 a.m., the skew is super steep, and your risk is high. But as the day goes on, it just naturally decays. It flattens out. By 3 p.m., the skew is way flatter, and that directly slashes the risk in your position.
And here's the proof. Remember that scary minus 0.156 number from the morning? By the late afternoon, it has collapsed by over 70%, all the way down to just minus 0.042. That hidden risk has literally just melted away with the clock.
This chart just says it all in one picture. The exact same trade, with the exact same strikes, carries a massively different risk profile depending on when you put it on.
In the morning, you're swallowing a huge amount of hidden skew risk. In the afternoon, that risk is down by 73%. It's the same trade, but it's a completely different animal.
Let's put this into terms that really matter. Cold, hard cash. If the market drops just 1%, a trade you put on in the morning is going to lose over 8% of the premium you collected. That same exact trade, if you put it on in the afternoon, loses only about 2%. That is a gigantic difference in performance, and is driven entirely by when you entered.
So that leads us to the final, really critical question. If this is so powerful, why doesn't everyone know about it? Why doesn't this show up in your research? Well, this is what your backtest is missing.
The problem is actually pretty technical. Most backtesting software uses a single snapshot of the volatility skew for the whole day, usually from the closing print. It then applies that one skew shape to every trade you test, whether it was at 9:30 a.m. or 3:30 p.m. It's completely blind to the fact that the skew is steep in the morning and flat in the afternoon. Your research is missing the entire story.
And this quote, oh man, this just perfectly captures that frustration so many traders have felt. Your backtest looks amazing, right? But then you trade it live, and there's this constant unexplained drag on your account. It's not you. It's the hidden skew risk that your backtest was never built to see.
And this is the most powerful takeaway of all. This isn't just about moving your strikes around a little bit. This is a fundamental shift in how you need to think. You have to realize that a 0 DTE Iron Condor that you open at 9:30 in the morning is a fundamentally different financial product than one you open at 3 p.m. They simply do not have the same DNA.
So it all comes down to this. For this specific strategy, the clock is just as important as your strike price. You're not just choosing a price range to bet on, you're choosing when to take on a massive hidden risk. So now that you know you're systematically paying for this risk every single morning, the question is, how will you trade differently?